Got it. 12:01.
Yes, so good afternoon, everybody. I would like to welcome you to today's Learn at Lunch webinar. We will hear from Extension Grain Marketing Specialist, Dr. Kim Anderson, as he provides a grain market update. If you have questions, please ask them through the chat window by clicking the chat button at the bottom of the screen. And you may find additional information on this and other farm management topics at the eFarm Management page. And I will share this link to the chat window. Dr. Anderson, I will turn it over to you.
All right. Well, thank you, Brett. I was just looking over. Hello, Brian. Don't get to see you now, but it's good to see you on here. I'll try to not disappoint you. But anyway, it's always a challenge to put together a presentation for a Learn It All audience. And so I might not be doing the traditional outlook. However, I'll see what I can do. I think if you looking at wheat, corn, beans, cotton, sorghum, especially wheat and corn, the number one thing that's impacting in the market is the war, Russia and Ukraine. We'll get to that in just a little bit. I did want to show you this slide that I got from the information I got from DTN. Shows the urea, DAP on dry fertilizer and liquid fertilizers 1034O anhydrous and UAN 32, so that you can see that these prices are coming down.
Dr. Anderson, I don't see your slides yet.
Okay. How about now? Let me click that. You got
Not yet. Not yet.
Well, it worked. Okay, let me go to here. Then back to there. One participant. Okay, you still can't see them. How about now?
Yes, now I see them. You're good.
All right, there we go. Now we're cooking. Okay, I got these prices off of DTN. They're updated on March the 3rd. So what are we, about 17, 18 days? I think prices are still coming down a little bit. But you can see on the dry fertilizer, your urea had went from a top of 1,022 a ton to 648. DAP from 1,033 to 827. And if you're looking at the liquid market, 1034 from 896 down to 741, anhydrous from 1526 to 1,077, and UAN 32 711 to 525. Yes, fertilizer prices are still high. However, they are coming down, and they're not quite as painful as they were at one time. And the trend is downward, and I think that's good news. If you look at the Oklahoma crop price forecast, what I like to use is the forward contract prices, and I'm going to use the forward contract prices for Pond Creek, Medford area. You can forward contract wheat for harvest delivery for $7.65. The current price is $7.90. If you go down, now that's a 50-cent under basis off the July contract. If you go down to Snyder, you've got a 75-cent under contract, or 25 cents less than Medford. If you go to Woodward, it's 10 cents less than Medford, and Perryton is 5 cents above. So your wheat prices around $7.65 for northern Oklahoma. And that pretty much represents what USDA comes out with the average monthly Oklahoma price. If you'll average Medford prices, it gets you pretty close. If you look at corn for the 23 crop, current corn price is $6.90. You can forward contract for $5.35 in north central Oklahoma. That's 25 cents under that December corn contract price. Snyder or southern Oklahoma, I couldn't find a quote down there, but Weatherford was a plus 45 cents. over the northern Oklahoma price, and the Panhandle area was 80 cents above that 535. If you're looking at grain sorghum, current price of 635. You can forward contract northern Oklahoma for $5. If Weatherford is also $5, and if you go out to Perryton, it's $5.50. Soybeans, 1471 current price. You can forward contract in north central Oklahoma for 12 1/4. No bid at Snyder. Weatherford is a dime higher, so 12.35, and Perryton is about 40 cents less than the price at Central Oklahoma. Cotton, current price around 75 cents, and that's about what the futures market is telling me that the price is. I don't have a forward contract price for futures, so I just use that cotton futures contract harvest, and I take 3 cents off of it. Canola, you can forward contract in northern Oklahoma for $6.55. Now that sets the stage for our prices, and I think that's probably the best predictor of prices. I personally think they're going to be just a little higher than that at harvest. There's a lot of risk in the market, and so most of your bids are going to have a risk premium in it that I think we'll lose as we get out into harvest. Another thing I think's, if you don't know anything else to say about it, interesting. The wheat forward contract northern Oklahoma is 765. Your crop insurance rate, now these insurance rates, the insurance time period is closed. You either bought crop insurance or you didn't, but your guaranteed price is $8.79 for wheat, $5.91 for corn, $5.84 for grain sorghum, $13.80 for soybeans, and 84 cents for cotton. So I think as we go through the rest of this presentation or discussion, you might remember these prices, because they set the stage or the foundation for prices between now and either the wheat harvest in the June, July time period, or your corn, sorghum, beans, and cotton later in the fall. Now, I mentioned the Russian-Ukraine war, and that may be the most important price factor, especially for wheat and corn to a certain degree, since Ukraine does export some corn. It just has an impact on both the financial and the commodity markets. To set the foundation for the discussion about the war, I think you need to recognize BRICS, B-R-I-C-S, which is Brazil, Russia, India, and China, which put together a trading conglomerate, and South Africa joined that group. Bangladesh, United Arab Emirates, and Uruguay are attempting to join the BRICS association. Now, this group, and it's an acronym for those countries, but the goal of these countries is to be the dominant suppliers of manufactured goods and services and raw materials by 2050. I think it's very interesting that Shanghai, China, is the headquarters for BRICS, and that you've heard probably in the news over the last year or so, keeps coming out ever so often about changing the US dollar or dropping the US dollar and replacing it with another currency as an international trade currencies. Some countries have already done that. So there's, I think, in the politics and the world politics, this is one of the underlying currents. And I think to a certain degree that the Russian-Ukraine war is a spin-off from this BRICS goal of replacing the Eastern Europe and the domination of the United States in the market areas, and replacing them with Brazil, Russia, India, China, etc. If you look at Russia, they before the war exported 19% of the wheat exports, number one, 13% of the oil, number two exporter of oil, 8% of natural gas, they were number four, 19% of the exported phosphorus fertilizers, 15% of nitrogen, 14% of potassium. In oil and gas, oil and gas makes up 45% of Russia's federal budget. Congressman Frank Lucas, I heard him refer to Russia as a major oil and gas company with an army. And to a certain degree, that kind of fits them relatively well, I think. You look at oil and gas, Russia, Saudi Arabia, and the United States are the top three. They trade back and forth during time, which one has the largest exports of oil and gas. China is the largest importer of oil and gas. So look at this, the Russian-Ukraine war, Russia not being able to export their oil and gas out to their traditional buyers, and China has become their largest importer. They're the largest importer around the world. So China is getting, let's say, buying oil and gas below market and providing a market for Russia. And I want you to keep that thought fresh in your mind as we go on here. They're the second largest producer of natural gas. That's Russia. And they have the largest natural gas reserve in the world. If you look at Ukraine, 10% of the world's wheat, number 7 exporter. Now, this was before the war. 14% of the world's corn exports, number 6, 31% of sunflower, 4% of rapeseed, and 3% of iron and steel. Now, remember, Russia's trying to take this over, and if they do, they will gain these exports and add them to their exports, and that will produce more power, political power around the world for Russia. And I think that iron and steel is something that we may overlook there, because especially when you're making military hardware. If you look at Russia and Ukraine, I've got Russia outlined in red, Ukraine in blue. That's Samson and David and Goliath, I think, is or David and Samson or whatever, the small battling the large. One thing that came to mind in the war that's going on in Bakhmut, and we'll get to that in just a minute, is that during World War II in Stalingrad, Volgograd now, Russia lost 950,000 troops in that location war for Stalingrad. And if you think of what they're losing now in Ukraine versus what they lost in that one battle in World War II, it's mind-boggling, and it's not a good thought. Now, the political situation is different now than it was then, but this just kind of gives you the giant versus the small there. If I put stars on here, in 1990, I had the honor of being on a diplomatic tour with the USDA in Russia. And of course, we went to Moscow, Kazan. We spent 4 days there. We spent 4 days in the Volgograd. And each day we'd go out, 250, 300 miles and visit the farms. Stavropol, Simferopol, and Kharkov. So I spent 3 to 4 days in each one of these locations. A good portion of this area that the current war is in, that area that has been taken by Russia, I have personally been in that area. And one point I want to make out of that is if you look at Ukraine, and if you think of Russia in this area, and you think of their farming, the wheat, the corn, the other commodities that they're putting on the market, you tend to think of them as maybe a third world country. If you will look at that situation, it's not. Now, the area here, the pink area is Russian controlled, the Dozhnik area and the Simferopol area there that's in black, they captured that in 2014. The other pink and blue areas there, that's not water, that's area that Russia had captured, that Ukraine has captured back from them. This is a current map as of the 19th. It shows the captured area and the recaptured area by Ukraine. What you're hearing in the news is the battles at Bakhmut. The Wagner group was leading that battle in there. The latest word on the street, and I get a daily military report on the war. And the word on the street is the war for Bakhmut has pretty much decimated that Wagner group, which in my opinion is the best fighters that Russia had. But so the circle, green and black areas is where the major wars are. The one that's in the news is the one right there in the middle, the Bakhmut. And here's a picture of that city. The pink is what Russia has captured. The major battles are being fought in that yellowish area, and you can see what city they have captured there and what they haven't. Now, so this area in red is a major agricultural area, and if you look at a satellite of that area and then bring it up close, you'll see that this is not a third world agriculture. This is high level, the latest technology and production methods being used to produce agriculture commodities. So these two countries, their ag production over the last 20 years or 30 years has improved dramatically, and that has made them a leader in world agricultural product exports and in the export market. So what does Russia gain from this? And I've said pretty much, not all along, one, they wanted to take the whole country. They weren't able to do that. But if they maintain what they've got, they already have the Simferopol here, but they're picking up major exporting elevators along this Sea Azov. And you remember, 6 months ago, Ukraine blew up a bridge. It was in this channel right here, which is the only way out of that sea to the Black Sea. But Russia will be gaining export facilities all along here in the Black Sea and in the Sea of Azov. Odessa is the largest Ukrainian export facility. And this Mykolaiv, which Russia, now this red line is now on the south side of this river here. So it might free up this Mykolaiv elevator here, which is another exporting facility for Ukraine to move their products out into the export market. So Russia gains export facilities. They've captured about 20% of Ukraine's farmland or farm production. So they'll pick up those exports. With the war, they could gain political power. They could also lose it if they was to lose that war. So caveat, and I heard this from some sources in Washington, D.C., is that Russia, and this is where China might be in there. No, China's in the background, and China is supporting Russia to a certain degree. China is getting to buy the oil and the gas at a cheaper deal. But Russia, if Russia depletes its resources and its military strength in the Ukraine war, then Russia could become kind of a satellite of China. And there's, remember the BRICS, there's more to this war than gaining the Ukrainian territory. I've heard this referred to as World War III, that it's not a ground war, that the real war is an economic war. It's an economic war between your Brazil, Russia, India, China, South Africa, against Europe and the United States, Japan, and other traders of those two groups. And that's the underlying current, I believe, we're looking at here, is this economic war. You look at what it does to the United States, it weakens our economy, our cost of production are higher, it stretches our resources, it drains our oil and gas. We're exporting a lot of gas to Europe to make up that natural gas that they lost from Russia. It makes us more dependent on imports of natural resources, our fertilizers. We get the fertilizers from Canada and other sources now. We lose control of our prices. We'll talk about corn in just a little bit. Brazil this year will probably become the world's largest exporter they're already exporter of soybeans, but the largest exporter of corn. It increases our cost of production. It increases our price uncertainty and the uncertainty for the demand for our commodities and the uncertainty of commodities around the world, and higher commodity prices. And that would be one positive impact to offset some of these negative impacts. Any questions or comments? Got one chat there. Okay. All right. If there's no comments or questions, I was thinking about going over this, and if I wasn't an agricultural economist, and there you get economists and they just give you a whole screen of numbers, and you think, gee, many Christmas, just can you tell me what's going on? And I did. I gave you the first couple of slides that gave you the bottom line results. And that's the most important thing you get out of this, is what's the market offering now? This gives you an indication of how it could change. If you look at the U.S. wheat situation, 15 through 22 years is the WASDE, World Agriculture Supply and Demand estimates. The 23 there is the estimates from the USDA's February Outlook Forum. And the bottom line there is that the USDA is predicting an average annual U.S. wheat price of $8.50. The way the market's acting right now, that may be a little high, but I think prices will probably come back up at least into our harvest. But that's just a guess on my part. But that $8.50, if you'll look back over the last 5 to 10 years, Oklahoma has averaged about maybe 50 cents less than the U.S. average price. It's not as far as it was, say, 2 years ago, and a lot of that is the relationship between hard red winter wheat, hard red winter wheat, soft red winter wheat, and spring wheat prices, as those price spreads change over time. But I think this 850 tells me that Oklahoma price is going to average somewhere around 8 to 8.25. You can look at the ending stocks, which I look at a lot, but over on the side there, I don't know if you can read those. I put the stocks to use ratio, which is the ending stocks divided by the use or consumption for that year. And we've seen U.S. Wheat stocks, this is all wheat, go from 56% in 2017 to 30% projected in 22 and 31% in 23. So I think the stocks to use ratio supports that $8 price. And I don't think I put the chart on here. I may pull it up in a little bit to show you a chart that supports the $8 Oklahoma price, $7.50 to $8.50, something like that. But out of all these numbers, what I get out of is watching, you got 608 million ending stocks and an 850 average, and the stocks, a very tight stocks to use ratio at 30%. And so what you got there, you've got wheat, the current price $7.90, the market's best estimate right now is $7.65. I think that's probably got at least 25 or 30 cents risk factor in it. That'd get it up to $7.90, up to close to $8. And your insurance is, your crop insurance is at $8.79. So I think the market pretty much, in my opinion, supports that this $8 price. Now, the problem there, and I'm not going to throw the numbers out, I'm just going to talk a little bit about Russia. Russia, their average production is around 2.9 billion bushels. In 22, they harvested 3.4 billion. Their exports are below average for their production this year. Their ending stocks are going to go up from about 365 million to somewhere around 550, 560 million. So they're going to have the 2023 production, which their crop looks relatively good. The last estimate I saw, it was right at average 2.9 billion. They're going to have another 200 million increase in any stocks. That gives them 3.1 billion to start with, to plus that carryover, that increased carryover. So they're going to have, if they get that harvest as expected, they're going to have excess wheat to export in the 2023-24 marketing year, and that could pressure that $8 price. That's going to come on as we get out into the late July, August, and September time period. That could support our prices in the June, July period, and then fall off later in the year. Ukraine, on the other hand, they're going to have about half of what they normally have, maybe 60%. However, Russia is more than going to offset. And you don't know how much of that Ukrainian wheat that would normally go to Ukraine will go to Russia to export. And we know Russia will get theirs out for export. Any questions on wheat? Okay, looking at corn, a bunch of numbers again. We don't produce a lot of corn right now. Some of your producers or some of the producers in the state may be, oh, my wheat crop looks pretty bad. If I could get it disastered out, then I can come in with corn rather than wheat. And that $8.79 insurance price there looks relatively well for if I could pull that off on doing that. You look at corn, the USDA on their Outlook Forum predicted $5.60 for an average price. The Oklahoma price is somewhere around that area. It's kind of difficult to calculate that, but my best guess is, and the numbers I looked at support Oklahoma prices right around that U.S. average. The question is, so you got it 1.34 billion, $6.60, and 1.9 billion ending stocks, $5.60. And I go back 1.9 up here on 19, I had $3.60. I had 1.74, but we've had a relatively large between 19 and 20. We had an increase in corn production, and especially an increase in corn demand. And if you look at the stocks to use ratio, in 15, it was 13%. It peaked out at 16% in 18, and it's 13 now. So the stocks to use ratio definitely supports, I think, the 560 going down that low. It tells me that if we have a good corn crop, prices could definitely go below that 560. I think there's more potential for downside corn prices than there is upside, but a lot is going to happen between now and August, September, and October of this year. So if you look at those corn forecasts, the current 690, 535 was what you can forward contract. That is below that 560, and I think that's your risk factor in there. There's a 25-cent risk factor there. I think that's the market's going to put that in there. And then your insurance at 591. And so, yeah, corn prices, if I was penciling out what, if I wanted to produce corn and compare it to sorghum or beans or some other crop, I'd probably use 5 1/4 or 525 to do that. Of course, our weather, with our weather, you don't know what your production is going to be, but you could forward contracts for your 535. Any questions or comments on corn? Okay, we got less soybeans in the state than corn, but soybeans is a crop that producers have been going to. Again, you look at these numbers on, you've got USDA's forum at $12.90, $14.30 at two. And there's not, I don't want to say a nickel's worth addition, but when you got any stocks, 260 million, 270, 210 million, 290 million, that's tight soybean stocks, and you'd expect tight, relatively high prices. But you can go back to 15, you had 200 million bushels and a 5% stocks to use ratio. And right now in 220, we got 5%. And in 23, we got 6%. And I think that's just a case, and it's just my pure speculation here. When you got back into from 19 to 20, protein supplies, the supply of proteins in feeds and foods got very tight, and they remain tight. And I think the market just bid up the prices. Plus, with your relatively high corn prices, if you don't have these relatively high soybean prices, you're going to have more corn produced and less beans. And the market, when you get down to ending stocks of 210 million bushels, and you're using 4.4 billion, of 5%, you've got 5% of your next year needs in ending stocks. You're going to have relatively high prices. So I think you look at these numbers, 290 looks relatively good. And what I read from others, I think they're semi-pessimistic with corn. They're semi-optimistic with soybeans. Of course, you don't know what's the one thing you heard me preach or talk about is that anyone says that they can predict prices lying, they're either not very smart or they're lying through their teeth. And I've got a song and dance for that we won't get into. But what the market does, we do know that I can forward contract soybeans. Where's my? Don't I have my forward contract? Interesting. I deleted, but I can get that rascal. Okay, let me do this. There you go. I do know I can forward contract beans for $12.25, and that my insurance is $13.80. So, and that currently it's $14.71. So I think these numbers supports current forward contract soybean prices may be slightly higher. I would give it just a little more probability of upside than it would downside. And also you got to remember that where you might have 25 or 30 cents risk premium in your corn and your wheat, you're going to have a 50 cent or 75 cent risk premium in soybeans. Also, if you look at US beans, you can see that shift in 19 to 20 here, a dramatic decline in ending stocks. You also saw that change in the world markets where you increased production, but you also increased demand all around the world. And then, you know, in the world, though, your ending stocks held relatively stable, but that shortage of protein, not just soybeans, but other protein commodities, I think resulted as partially the result or the cause of these higher prices. And I don't see any reduction in that shortage of protein feedstocks. Okay. Looking at cotton. Now cotton, the USDA, I couldn't find numbers for 2023-24 for your grain commodities. However, USDA did produce one in the forum for your cotton, which I'll show you those numbers. The USDA is predicting an average price of 80 cents. The Oklahoma price gets pretty close to that on the average if you watch Texas Panhandle, Oklahoma prices. You can see the ending stocks projected slightly lower in 23, but higher than in 21. And you have a slightly higher 80-cent price there. Your 7-year average price, and that's 16 through 22 is 72.5 cents. So you got a projected 80-cent price. If you look at the world cotton, and I think you could, it's interesting to note that production in the United States in cotton has maybe even declined a little bit. You got 16, 17, 18, 19, and then 20 a short crop. And then we haven't, our production's actually, in my opinion, lower than it was back down here in the 16, 17, 18, 19 time period. Our use also slightly lower. Our ending stocks relatively flat for the most part, in my opinion. And so I think the big driver of these prices is probably your world market and the tightness maybe of stocks in the US. But here you had 3.8 at 61 cents, and here you got 4.0 at 80. If you look at the world cotton situation, you've got 106, 123, again, kind of decline in production around the world in cotton. The use 116, variability of use, but relatively stable, and your ending stocks relatively flat, maybe even a little higher now. And so with those, you've got higher prices, and I think that goes back to your other commodities, your corn, your soybeans, and your demand around the world. You've got your war, you had COVID, that I think increased demand for commodities. I think you don't necessarily see it in ending stocks, but I'd ask you, how many of you's got an extra package of, and I don't mean one roll, I mean an extra package of toilet paper or paper towels or whatever. I've got, I do have a package of flour frozen in the deep freeze. And if everybody's got a 5-pound bag of flour in their deep freeze or put it back on the shelf, that does not show up in these stocks around the world, but it is excess stocks. And I think COVID and the war has got around the world increased demand at the consumer level and to a certain degree at the state level of maintaining a higher level of ending stocks. And that would, in a way, increase demand. So you look at cotton, the current price is 75 cents. The 2023, I think the futures is around 78 right now. I'll take 3 off of that to get to 75, and your cotton insurance is 84 cents. I don't cover canola, but I did look up the forward contract price for canola, and that is 65 cents. So, any questions or comments? If not, let me finish up. Your success and quality of life is directly related to your ability to raise and sell a quality product that the market wants to buy. And with that, I thank you.
Thank you, Dr. Anderson. I have set it where people can unmute themselves to ask questions or ask questions through the chat. Thank you for your presentation today. And I shared a link to a survey in the chat window. So we would appreciate if everyone would fill that out and help us know how we're doing. I also want to let everyone know that we do have another webinar scheduled. It will be April 11th at noon. And Dr. Rodney Jones will discuss spring crop opportunities in this webinar.
All right. Thanks, Brent.
You're welcome.
I'm gone.
All right. Thank you, Dr. Anderson. Thank you, everyone, for joining us, and we will see you on April 11th.